Interest rates. Is the pain finally over? Is the Federal Reserve satisfied with rate hikes yet? Before we begin, remember to like this video and subscribe for more economic updates. I am Devlyn Steele, Director of Education at Augusta Precious Metals, here with a look at some of the biggest news that emerged from the economy over the last several days. Leading the news this week, the Personal Consumption Expenditures Price Index, known to be the Federal Reserve's preferred inflation metric, decelerated in October. Each of the index's key measures declined in October. Headline PCE rose just 0.05% month over month. Year over year, PCE climbed 3%, down from 3.4% in September. Core PCE is now at its lowest level in more than 2.5 years, suggesting the possibility that inflation is working its way back to 2%. Currently, traders are betting overwhelmingly that the Fed will leave interest rates unchanged at December's policy meeting. And some economists now are raising the possibility we could see rate cuts as soon as spring of next year. Elsewhere this week, the Conference Board revealed that its widely followed Consumer Confidence Index increased in November for the first time in 4 months. But it seems there's a little wrinkle in the data this time around. Heading into the week, the November index was projected to fall slightly from October's originally reported 102.6, and it did decline from there, down to an even 102. Excluding October's downwardly revised 99.1, the Consumer Confidence Index right now is at its lowest level since last December. And a component measure of the overall index, the Expectations Index, which asks consumers to look 6 months ahead, finished in recession territory in November for the third straight month. On Monday, the Census Bureau reported that sales of new homes in October fell 5.6% month over month, to a seasonally adjusted annual rate of 679,000 units, 40,000 units less than September's downwardly revised rate of 719,000. Unsurprisingly, analysts attribute the drop to ongoing challenges posed by higher mortgage rates. In October, the rate on a 30-year fixed-rate mortgage approached 8% for the first time since November 2000. However, economists expect to see figures for new home sales make a comeback this month and the next on the strength of the anticipated decline in mortgage rates. Finally this week, we learned the economy grew even faster in the third quarter than originally thought. According to official government numbers, on Wednesday, the Commerce Department announced the second estimate for GDP in the third quarter came in at an annualized rate of 5.2%, 1 percentage point higher than economists' projections, and 3 percentage points higher than the initial estimate. It's worth noting that the revision is attributed to stronger numbers for business investment and government spending. Consumer spending, which represents roughly 70% of GDP and therefore is the principal driver of economic output, was revised downward to a growth rate of 3.6% from the initial estimate of 4%. That certainly is a lot of data this week, which can be difficult to understand at times. Make sure you subscribe to this channel to learn what the data means. This is Devlyn Steele for Augusta Precious Metals, signing out.